Blockchain is revolutionizing industries worldwide, but did you know it's also transforming the way companies handle their finances? In the fast-evolving world of accounting, accuracy, transparency, and security are critical. Enter blockchain, a game-changing technology that's shaking up traditional financial reporting and auditing processes. Whether you're a finance professional, a business owner, or simply curious about the future of accounting, this video will take you on a deep dive into how blockchain is creating real-time, tamper-proof financial records and redefining the audit process. Stay tuned as we explore the powerful potential of blockchain in accounting and how it's shaping the future of the finance world. 1. What is blockchain technology? Blockchain technology is based on a distributed ledger system. The core idea is that all participants in the network, also called nodes, maintain identical copies of the ledger, and any new transaction is verified by multiple participants before it's added to the ledger. This process, called consensus, ensures that the data is secure and tamper-proof. Here's a breakdown of its fundamental characteristics. Distributed ledger. Instead of having a central authority controlling the data, like traditional accounting systems, blockchain distributes control across a network of participants. Every node in the network holds the entire ledger and updates it as new transactions occur. Immutable. Once a transaction is recorded in a block and added to the chain, it cannot be altered without changing all subsequent blocks, which is nearly impossible without detection. Consensus mechanisms. Blockchain uses mechanisms such as proof of work, POW, or proof of stake, POS, to validate transactions. These consensus mechanisms help ensure the legitimacy of data before it's added to the blockchain. 2. Key features of blockchain in accounting transparency. Blockchain ensures that all participants in the network can view the same version of the ledger. This is especially important in financial reporting, as it reduces the risk of manipulation and enhances stakeholder trust. Use case. Imagine a company issuing bonds. With blockchain, every step of the bond issuance process is recorded and visible to regulators, auditors, and stakeholders, ensuring transparency. Security. Blockchain uses cryptographic algorithms to secure transactions. Each block is linked to the previous one using cryptography, making it extremely difficult for hackers to alter the ledger without modifying the entire chain. Example. In traditional accounting systems, financial records can be manipulated without immediate detection. With blockchain, any unauthorized changes would be immediately noticeable to all participants. Decentralization. Unlike traditional financial systems where a central authority holds control, like a bank or regulatory body, blockchain allows for decentralized operations, where no single entity controls the ledger. Application. In accounting, decentralization eliminates the need for a single authority to control and validate transactions, reducing delays and increasing system efficiency. Smart contracts. These are self-executing contracts where the terms are directly written into code. Smart contracts automatically trigger actions, like payments, when conditions are met. Example. In auditing, a smart contract could automatically release payments to vendors once specific conditions, like product delivery, are met, reducing the need for human intervention. 3. How blockchain is transforming financial reporting. Real-time financial reporting. Blockchain technology updates financial data in real time, ensuring that financial statements are always up to date. Example. A global company using blockchain could provide real-time access to its financial position to auditors, investors, and regulators. The need for end-of-period reconciliation is eliminated as the ledger is constantly updating with each transaction. Streamlining audits. Traditional auditing is time-consuming because auditors have to verify transactions manually and trace them through various accounting records. Blockchain simplifies this by providing an immutable and clear trail of all transactions. Example. Instead of manually reconciling a company's sales or inventory records, auditors can rely on blockchain to instantly verify transactions, cutting down the time and costs associated with audits. Reduction in errors and fraud. Blockchain's design ensures that once a transaction is verified and added, it cannot be modified without leaving a trace. This drastically reduces the risk of errors or deliberate manipulation. Case study: a blockchain-based accounting system could prevent fraudulent transactions in companies that deal with multiple stakeholders, such as supply chains, where fraud can be harder to detect. 4. Impact on auditing processes. Automated audit procedures. Blockchain can automatically verify whether certain transactions meet predefined criteria, such as matching invoice payments to the delivery of goods. Example: imagine an auditor tasked with verifying thousands of transactions. Instead of manually cross-referencing data, they can use blockchain to automatically confirm that transactions meet certain criteria, such as approval from all parties, reducing the need for extensive manual checks. Continuous auditing. Blockchain allows auditors to verify transactions as they happen instead of performing audits after the fact. This continuous audit model ensures that companies remain compliant with accounting standards in real time. Application. An auditor could be given access to a company's blockchain network, allowing them to monitor transactions as they occur and identify potential red flags early, preventing larger problems down the line. Increased accountability. Because blockchain creates an irreversible record of every transaction, it enhances the accountability of both businesses and auditors. Every action is traceable, which reduces the opportunity for manipulation. Example: in a financial fraud case, blockchain can provide investigators with an accurate and untampered record of transactions, making it easier to identify when and how fraudulent activities occurred. 5. Challenges and limitations of blockchain in accounting. Regulatory uncertainty. Blockchain is still a relatively new technology, and there are limited legal frameworks and standards governing its use in financial reporting and auditing. This uncertainty can make it difficult for companies to adopt blockchain solutions. Issue: different countries have varying regulatory environments, and blockchain technology might not yet comply with established accounting principles like GAAP or IFRS. Integration with existing systems. Incorporating blockchain into existing accounting systems can be expensive and time-consuming. Many companies have built their financial systems over decades, and transitioning to blockchain requires a significant overhaul. Solution: companies may need to use hybrid systems, where blockchain is used for certain aspects, such as audits, while traditional systems remain in place for others, like payroll. Skill gaps. Accountants and auditors need specialized knowledge to work with blockchain systems. Traditional accounting education does not yet fully prepare professionals to handle this new technology. Solution: companies must invest in training programs to upskill their staff in blockchain technology. Scalability issues. As the number of transactions increases, the time it takes to verify and add them to the blockchain grows. Public blockchains like Bitcoin or Ethereum often experience slow transaction times, which could hinder adoption in high-volume industries. Solution: companies may need to adopt private blockchains for internal financial reporting, which offer more control and scalability compared to public blockchain networks. 6. Future outlook. Blockchain's impact on accounting and auditing is just beginning. In the coming years, we're likely to see the development of blockchain accounting standards, new software solutions integrating blockchain with traditional financial systems, and more widespread adoption of smart contracts in accounting practices. Companies that embrace blockchain early may see significant competitive advantages in terms of efficiency, security, and transparency. Conclusion: blockchain technology offers significant potential to enhance the transparency, efficiency, and security of financial reporting and auditing processes. As more companies experiment with blockchain solutions and regulatory clarity improves, blockchain could become a cornerstone technology in the accounting field. Make sure to hit the like button and subscribe to the channel. Don't forget to turn on notifications so you never miss out on future content. Thank you for watching, and I'll see you in the next video.